Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on January 30th, 2023. I'm still getting used to saying 2023. We trade tomorrow at 11. Light trading probably one position and more alerts. We have big earnings next week. Well, I'll discuss in a moment. I'm going to go over trades and results from last week. We had a good week. And the second part, call it a mini-series on helping you identify stocks, which is the fundamentals of the companies, real-world companies, the fundamentals of the companies, not charts, not metrics, not Greeks, not options, the fundamentals of the companies that we will be and you should be trading options against. So we closed two trades. A position rolled over from Chewy and, of course, the block trade. And the rates of return here, especially for block, may seem low, but we're going to go to the next page. You'll see the cumulative impact of what we did in a week. And please remember, remember if you're new, I am measured, you measure me on wins and losses. This is not a portfolio approach, and we use annualized rates of return, both on positions and the amount of capital that we have outstanding for open trades. So this was the whole roster of what we did last week. And, one of the things that you'll be seeing is that with Marvel, we actually spent some cash because the stock had popped, and we were able to extend the trade a few weeks, pick up several dollars in what I call realized appreciation, meaning it's the new strike price is still in the money. And that has an impact, of course, overall on your management of the position, has a slight negative impact on how you would review results. That being said, we still had excellent annualized rates of return, and I cannot emphasize enough, this is where the management of individual positions and goals for your portfolio come into play. I mean, we have a 26%, 0.5% a week target. Many of you may be more aggressive, many of you, including myself in my own portfolio, less aggressive, and it depends on the stage in life and what your experience are and whatever. But this is what drives position management and overall what you're managing in the course of a week. Breaking it down, the new trades had a really nice rate of return. The roll trades, as I said, we spent some cash on Marvel to push the strike price way up from where it was, and still, if you were called out, you captured much more of the appreciation in the stock. And this is all set against a backdrop of a very busy January and early February. The market rose quite nicely based on GDP results, which were much higher than expected. Intel was a downer, which now is an overhang on the tech announcements this week. Really bad earnings. And they said that PC demand was quite soft, and server demand for the big giant servers that help us access the internet in server farms was softening. And the Microsoft forecast for tech, which had happened the previous week, sort of was mitigated, that's too mild, was mitigated, was shrugged off by the big GDP number. I personally, and I'm not, trying to be a Monday morning quarterback saying that I was right about something. The GDP number should not have surprised people as much as it did, because consumers are still spending. They're drawing down their credit lines. They're drawing down their bank accounts a certain amount. They feel that the worst sting of gasoline and food inflation may be abating. You put this all together, people are reading headlines. I remember this was a month and a half ago, or maybe it was 3 weeks ago, the president of United Airlines said the only hint that he has of a recession is reading the headlines in newspapers. And that's true of many people, and they're still spending. They're spending in a different way that I think is hard for Wall Street because of institutional biases to understand. What I want to go over now is how you can see what's going. I just spoke about the real world and real world GDP. What does that translate into? What are you looking for? What kind of companies may benefit either from a softening economy or a strengthening economy, or a weakening economy with a strong consumer? I mean, that's not necessarily a backdrop you have to worry about. I do. But I'm going to walk you through briefly this little mini-series on how you can find companies in the real world. So first, with your eyes, you're reading, and you see a headline, you read the article, demand for semi-trucks, big trailer trucks on the highway that drive you crazy, is surging. and there are 4 companies that stand to benefit. Well, let's take that headline, just the headline, and move on. What does more trucks tell you about the economy? Well, it means if people are buying more trucks, they're comfortable with the economy either staying where it is or getting better, and they have access to capital. Um, the impact of higher diesel prices and electrical vehicle subsidies is also driving demand. The spreads between diesel and gasoline are the largest I've ever seen in my professional lifetime. They're just gigantic, and that says, well, we got an old truck, we can pay off a new truck in 3.5 years just by getting rid of the old one and putting a new one on that is much more energy efficient. And there are EV subsidies coming for all sorts of vehicles if they're manufactured in the United States. And most trucks and truck components are manufactured here. The big ones are manufactured here. Reshoring, what does that mean? Supply chain disruptions due to COVID, geopolitical issues, and increasing costs in places specifically like China means there's a new calculus in whether we should build in the United States. To a lesser extent, Mexico and Canada, but the United States. And over $40 billion in auto manufacturing facilities construction is underway because of EV subsidies. So you have a situation where people doing trucks are going, there's going to be a lot of stuff moving around. And what that leads you to is what specific in sectors can I start looking for? And let's shift. Your airplane is full. Mine was going to and coming back from Rome. And mostly, if I get it right, mostly consumers / vacationers and not business. And people, including me, were really concerned that the more valuable and profitable first and business class travel was permanently impaired, which I believe it has been by COVID and people getting used to Zoom. But this gap has been filled, and at higher prices than even 6 or 8 months ago, with vacationers traveling. My airline, and this was United at the time, has invested in 2 clubs, not just one, the regular lounge and one for international business and first class. Don't laugh. The flight crews are laughing. And not just back to work, but back to full planes. Admission. I was in the Polaris Lounge in Newark, and I left the charger to my power cord there. I was talking to a woman. The company remained unnamed because it's publicly held, and I'm now looking at it. Who's with a major consumer goods company, and I didn't pry about any financial information, but I wondered how business was, in general, how the brands were doing. Got wrapped up, looked at my watch, put everything away, and bingo, I get on the plane about half hour early because it was, group 1, and I realized I don't have my power cord, and I'm flipping out. So I run to an attendant, the attendant speaks to another one, and voila, 20 minutes later, someone has gone to the lounge and picked up, first of all, it's great customer service, picked up my power cord. I then be very thankful, since I'm in business and the drinks are free, I offered to buy the entire crew drinks, and they were all laughing. So I said, how are things going? And they said they love being back. The flights are full. Passengers are no longer unruly, at least in their experience. Not anymore since a couple of years before the pandemic. And, that they know new planes are coming, they know more capacity is coming, they know new hires are coming. And this is all just a feel that you get as an observer, but it's meaningful because these are people doing the job. Do the same for yourself. Do the same with your friends, and the easiest things for you to do, obviously, consumer products, travel, things like that. And fundamentals are different. Each sector and each company, fundamentals vary in terms of their importance to the performance of the company. And measuring Apple's operating margin is apples compared to GM's operating margins. The worst year that Apple will ever had will be 3 times better than the best year General Motors ever had in terms of what is called operating margin. And operating margin, which I'm going to get into at length when we're in Las Vegas together, operating margin is the critical metric for me when I'm looking at the performance of a company. But my point here is when you're doing your investigations, these metrics to Wall Street analysts who then tell their traders buy this, buy that, it depends really on the company and the sector. So it's all sector specific. The importance of market share, I think, is both overblown and underblown. A small to medium-sized company that's flaring up and is doing extremely well, market share gains or retention of stolen market share becomes very, very, very important. A company with expanding profits and revenue is maintaining market share is very important. 2 examples. Crocs has maintained and expanded its market share coming out of the pandemic, which completely surprised Wall Street. They're very important to the stock. In the case of Chewy, they've maintained auto ship. They got back to where they were. They're maintaining and slightly increasing their market share, but their operating margins are going up. Very important to the stock. So you can see it's different. But growing market share creates its own success. It creates more brand awareness, which creates more sales. It creates more revenue and more operating margin, which creates more marketing dollars and research dollars, which create more sales, and so forth and so on. But it does vary sector by sector, but it's a very important metric. Revenue growth is also sector specific. You might be very happy with 4 or 5% revenue growth adjusted for currency for Deere and for Caterpillar, but for Amazon you might want to see 20% or 15 or something like that. It's very, very company and sector specific. What you're looking for must be faster than the sector. And it should be faster than the average revenue growth in the S&P 500. It should be seen as sustainable. And I'd say 7 of the 10 stocks that we will trade against that are in my bullpen, revenue growth is a very important metric for Wall Street. Now, of course, let's go to what theoretically everything is measured on, which is profits, and it varies wildly. The two things are the price earnings multiple and the PEG, the price earnings over growth. But let's focus on the PE. It's very different. Autos, for example, have always sold at 2/3 the price earnings multiple of the S&P 500. So keep that in mind. And yet there are dozens of winning companies, Amazon for 10 years, maybe more, that had no profits or lost money. And the same with Chewy, for example, for many years. And there are 3 phases of profit growth, which is pre-profit, initial profitability, and sustainable profitability. You have to tell yourself which phase is my company that I want to trade in, and then decide from there what happens when they move from one to the other. One of the examples is Cheniere Energy was unprofitable forever. They were the first, and now they're by far the largest liquefied natural gas exporter in the United States. Huge amounts of capital investment. When they went over to being profitable, the stock held up. The metrics changed, and yet the stock held up. And that's a transition that can be very difficult for any of us to analyze. And the valuations that Wall Street places on a stock may go back to pure revenue growth depending upon profitability. And here's the thing that's going to be the most difficult thing for you. It's a little less difficult, or a little bit more than a little less difficult for me, and that is the importance of management. It's, to me, the most important thing. Evaluating management, with traders don't care, investors do. And there is a difference. And evaluating management's the most difficult thing that I do or you could do. And for example, there's Apple's Tim Cook, General Motors' Mary Barra, and Amex's Stephen Squeri. What they've done is transition their companies, building on a brand, building on an employee base, building on a capital base into new markets without in any way significantly damaging or at times increasing profitability. And I've not mentioned American Express before. It's something we probably won't trade in Options Income Blueprint because of the stock price, but not the stock value, but the stock price. But they've made an amazing sequence into consumer lending, phasing out their traveler's check business, which used to be important for the float, for changing the travel business, which so much is online, and so forth and so on. It's been remarkable, and it has been going on for many years. He's the inheritor of some of the changes, but he's been managing them very well, and earnings just came out, and they were very good. So different fundamentals and terrific management includes the management relationship with Wall Street. This little company called Figs, it's the only pure play on healthcare, worker clothing, really nice company, tremendous website, great brand. In their first earnings announcement after their IPO, they just blew it. They had good earnings, and they didn't know how to tell Wall Street the story, and the stock cratered. We will get to numbers. We're going to evaluate stocks, which is different than evaluating companies next week. We'll look at all the things that you hear people babbling about or writing about. And this is all tip of the iceberg compared to what we'll be going through together when we're in Las Vegas. Now, this week, look at the earnings. You have Apple, Caterpillar, Corning, which is a misunderstood marker of what's going on in the world. General Motors, Google, McDonald's, Meta, Pfizer, T-Mobile, just to name a handful. And the risk on trade has been back. Crypto is up. more speculative stocks are being bought. Let's see what happens. Let's see what happens with the Fed meeting. Let's see what happens with these earnings and whether the risk-on trade continues. Risk-on meaning investors, not just traders. Investors are spending more money on stocks that are less profitable and more speculative. And again, expect maybe one trade. We'll certainly do one trade tomorrow, but I doubt if we'll do two. We might have to wait till Friday again. And the shift to bonds has been slowing because of belief that the Fed is only going to announce a quarter of a point. And this uncertainty, of course, creates us opportunities. Let me be clear. If the Fed, for some reason, has a half-point rate hike, the market's going to sell off in a vicious way, in a really vicious way, and you have to be able to trade through it. It should or would or might come back in a relatively short period of time, but there'll be enormous damage in the bond market, and that will spill over into equities. There'll be bloodbath and bankruptcies in the bond market for little guys taking extreme bets on certain bonds. So we're going to be careful. I spoke about Investors Blueprint Live, probably the best couple of days you could spend, have some fun, learn from me, we have a whole bunch of speakers, and also, of course, your peers, your colleagues. It's brand new content, including a primer on doing what we do here, but with a much tighter link to your weekly and your monthly and your quarterly and your yearly goals. And of course, we have office hours and so forth and so on. So check it out if you will. Thanks for listening. This is Michael Schulman.